Asian markets lead losses on Beijing lockdown fears. Shanghai stock index plunges more than 5% as the country struggles to contain its worst outbreak of the virus despite harsh lockdowns. All global markets down, even crude oil softens as speculators retreat. A bad start to the week for the bulls as markets see all-round selling. Sensex plunges over 600 points, Nifty ends below 17,000. Investors lose 6 lakh crores in 2 sessions as weakness across global markets dented sentiments. Shares of Kishore Biani-led Future Group companies plunge up to 20% as Reliance Retail withdraws its near 25,000 crore rupee purchase offer. After crude oil, prepare yourselves for an edible oil shock. Food and FMCG companies set to jack up prices as Indonesia stops supplies of palm oil. Highways Minister Nitin Gadkari's warning on e-scooter fires has an immediate impact. Manufacturers announce recalls and now rush to meet top ministry officials in Delhi. Twitter set to accept Elon Musk's $43 billion takeover bid. Deal could be signed anytime tonight. Exactly 3 weeks after Elon Musk announced that he had bought 9.2% stake in Twitter, Twitter is now all set to sell itself to Elon Musk for $54.2 per share in cash. This is the price Tesla CEO Musk offered and called his best and final offer. According to reports, Twitter's board is seriously considering Elon Musk's bid, and they may announce the $43 billion deal soon once the board has met to recommend the transaction to Twitter shareholders, according to sources. It's always possible that the deal collapses at the last minute. Well, it's a sea of red everywhere you look. Rising inflation and a surge in COVID cases are wreaking havoc across stock markets and the commodity market. Dalal Street was in the bear grip for a second straight day in line with global players. Oil also slumped to about a 2-week low, extending last week's decline. China lockdown woes hit the commodity universe with metals like gold, silver, iron ore hitting a month low. The benchmark indices have succumbed to intense selling in the last 2 trading sessions. Sensex has cracked 1,500 points and Nifty has shed 503 points in the past 2 days. A 50 basis point rate hike that can be announced by the Fed next month weighed on investor sentiment. China's worst COVID outbreak wreaked havoc not only on the Shanghai Composite but also on Dalal Street. Post Indonesia's ban on palm oil exports, FMCG stocks tumbled in trade. Even quarterly earnings have spelled bad news for markets this season. Our global business editor, Udayan Mukherjee, joining us now. Udayan, markets continuing to keep us on tenterhooks. Not sure if the volatility currently is due to earnings or the backdrop of impending rate hikes, of course. What do you feel is keeping them on their toes?
But there are many reasons, and we spoke about them last time too, and I did suggest that the market was looking slightly shaky and that Nifty might go down to below 17,000 levels, which it indeed has now. But I think the major cause of volatility is still global because the US market is looking quite shaky, and the recent falls towards the end of last week were quite nerve-wracking. This is a very important week for the global markets because we have some of the biggest stocks in the world, Apple, Amazon, Microsoft, all reporting earnings out there. And I do hope that some of those earnings will lift the pall of gloom on Wall Street. Because if it does not, and the Dow and the Nasdaq keep collapsing, then I think we are headed for much lower levels in India as well. But keeping that aside, the Indian earnings season has not begun particularly well. You saw that shock with Infosys, with the margin performance out there and the fairly muted kind of guidance, and that stock has corrected, bringing down IT stocks overall. So the start to the earnings season, which was always looking tricky this time, has not been very auspicious. So it's a combination of factors. It's largely global. Also the fact that Indian earnings are not lending terrific support, and at the end of the earnings quarter this time around, I don't think there will be too many upgrades. There might actually be a few downgrades. So the best case scenario for the market is that we hang around just below the 17,000 level and keep attempting these rallies to say 17,300, 17,400 levels. I mean, if this passes with volatility and some consolidation, I think we should all be very happy. But my fear is that the inflation fears keep growing overseas and the global markets remain shaky as they are, then we could be headed for even lower levels from here on. So fingers crossed that things turn out okay, but I'm prepared for more volatility through this month. A very old timer in the market, S. Naren, who runs a very large corpus of money at ICICI Prudential Asset Management Company, one of the largest fund managers or mutual fund houses in the country. Naren, great to have you on the show. And we'll talk a lot about the stock market, but I want to ask you about how you're feeling about various asset classes now and the interplay between them, because you do run successfully many multi-asset funds, and it's an interesting time for these multi-asset funds because there is uncertainty in equity. Interest rates could be changing around, which is very germane for the debt market, and gold has been rising because of the global uncertainty. How would you allocate money between various asset classes in the light of these changes today?
Actually, it's a very interesting time for multi-assets, primarily because every asset class goes up and down. So, if you look at bonds in the very recent past, bonds have done well. No one would have believed that yields will drop, but yields have dropped in the last few weeks, the last week. And there were times when gold did well, then there were times when equities did well. So we are in a period of time where there are times when gold does well, there are times when bonds do well, there are times when equities do well. So you have a situation where something like multi-assets, where different types of assets are there in the fund, and you have different types of equities also, which is value or growth and quality, does well. It becomes much more interesting because different asset classes tend to do differently at different times. So it reduces overall volatility of the whole, and that becomes more interesting from an investor point of view. And I think till the time the Federal Reserve in America says, I'm done with tightening and I'm now going to stop increasing interest rates over the next 18 months, I think equities will remain a volatile asset class. So it is much better for any investor to consider something like multi-assets over equities, because equities will be too volatile for most investors.
Volatility is understood, Naren, and that's part and parcel of an equity investor's life. But in an absolute sense, do you think the risks are stacked against equities for the next 12 to 18 months? I mean, I'm not asking about the fact that markets may go up and down, but do you think there is absolute downside to this market, given where valuations stand today and given the risks that we are talking about?
Actually, if you had asked me this question, I would say yes, particularly for small and mid caps. But what has happened at this point of time is that, the retail investor interest in Indian equities is something I've seen on a scale which I've never predicted before. And, I've seen it in early 90s in India, and after that I'm seeing it now. So if you ignore the retail investor interest, I would have clearly predicted much bigger falls possible in both small and mid caps particularly. And we at ICICI Prudential have been surprised by the level of retail investor interest in equities. Purely on a valuation basis, we believe that the small and mid caps have more downsides. Large caps have seen such huge selling from foreign institutional investors that valuations on the large cap side is not so high that it doesn't appear that you can see very, very large selling from foreign institute on the large cap side, or big corrections possible on the large cap side. But it all depends on how retail investors behave over the next 12 to 18 months. Rather than anything, and it has not been easy for us to model how retail investors will behave, because in India what we have noticed over the recent past is people are more comfortable with equities as an asset class than they are with other asset classes. And if that trend continues over the next 12 to 18 months, then I think the downside is lower, because at some stage the foreigner is going to come back to India. It's not that the foreigner does not like India. It is just that temporarily they need to pull out money from emerging markets, so they're selling India. But I believe that if I take a 3-year view, at some point of time India will come back into fashion for the foreign institutional investors, and they'll start investing in India. So if in this period when FIs are selling, if the Indians manage to hold on, I believe at some later stage the foreign institutional investor will also come back into the buying bandwagon very clearly.
And nowhere is it more stark than, the blue chips of yesteryear, like the HDFC Bank and HDFC Twins. And for a brief while after their merger announcement, on the day of it, it looked like they were now set to catch up on that underperformance. But once again, they've started slipping and underperforming the market. As a fund manager, you've had experience of owning these companies over long stretches of time. What do you make of this kind of underperformance from one of the bluest of blue chip houses of India in the financial space?
See, we don't talk of individual stocks, but our investing framework requires at ICICI Prudential to look at an long-term intrinsic value of a sector and a stock, and then look at the current value and see whether it is relatively attractive compared to that, and increase the holding of that stock. So 2 years back, for example, metals had reached throwaway prices, and at that point of time people were more positive on auto than on metals. Our view was auto required the utilization of metals, consumer durable required the utilization of metals, but people believe that auto and consumer durables could be made without metals. So the long-term intrinsic value framework that we had suggested that we have to look at metals instead of looking at auto and consumer durables at that point of time, and that framework is what framework we use across sectors and across stocks at all points of time. And so with that framework we look at different stocks, and as you know, there is always greed in the market at some points of time, fear in the market at some points of time, and the greed and fear frameworks that come at various points of time is what gives hope to fund managers like us to actually deliver long-term active management returns for many investors, and give investors the benefit of the mutual fund industry. And that is what we work through many of our asset allocation frameworks and various other schemes that we run at ICICI Prudential.
All right, and you can catch that entire show on businesstoday.in and our YouTube channel as well. Full conversation with S. Narain, including all that he's bullish on as volatility continues in the stock markets. A bloodbath for investors of Future Group companies, with up to a fifth of their wealth wiped out today. Reliance Industries had on Saturday announced that it's pulling out of its bid to acquire Future Group's assets for 24,713 crore rupees after secured creditors of the Kishore Biyani-run companies voted against the proposal. Shares of both Future Retail and Future Enterprises dropped to their lower circuit of 5%. The other three listed Future Group companies, Future Lifestyle, Future Consumer and Future Supply Chain, were all also locked at lower circuits of 20%. Banks have been left high and dry once again by Future Group. According to reports, bankers of flagship Future Retail are left holding Kishore Biyani's personal guarantee, as well as those of his elder brother Vijay Biyani and cousin Rakesh Biyani, all of which are difficult to execute. Even the corporate guarantee of 5,700 crore rupees by Future Enterprises is meaningless because the company is already a defaulter in the market. Moreover, troubles are mounting for the Future Group. Bank of India, the leading lender of FRL, has approached NCLT for a resolution under the Insolvency and Bankruptcy Code. The Future Group companies owe around 24,000 crore rupees to banks. We take a quick break. On that note, more corporate news on the other side.
Pakistan has resorted to cutting electricity to households and industries as it can no longer afford to buy coal or natural gas. Reports suggest Pakistan's energy costs have more than doubled in the past 9 months. But what has caused this shortage and why is Pakistan going dark? Reports suggest that Pakistan has been battered with acute fuel shortage, and Russia is one of the reasons. With the ongoing Russian invasion of Ukraine, prices of coal and gas have skyrocketed. The cash-strapped country can no longer afford to buy coal or natural gas from overseas to fuel its power plants, as prices of liquefied natural gas have increased. At present, Pakistan's energy cost stands at nearly $15 billion, which is almost double of what was 9 months ago. In a Twitter post, Miftah Ismail, Pakistan's finance minister under Shehbaz Sharif's leadership, revealed that nearly 7,140 megawatts worth of power capacity had been shut due to fuel shortages, which represents almost a fifth of the total generation capacity. Ousted PM Imran Khan and his PTI party is being blamed by the Pakistan government for the current crisis. It is pertinent to note that the country has also been unable to spend more on additional shipments, triggering a situation when residents had to offer Ramzan prayers in darkness. Pakistan is highly dependent on energy imports. The electricity crunch is complicating the already tough economic challenge for PM Sharif. Pakistan's long-term LNG suppliers also cancelled several shipments over the last few months. The power outages are forced to deal with the energy shortages, and officials suggest that Pakistan's situation will not change any time in the near future, since global dynamics still remain the same.
When it's the world's biggest news story, there's only one gold standard of journalism.
Welcome back. FMCG companies in India have been rocked to the core by the ban on palm oil exports by Indonesia. Palm oil is the most produced, consumed and traded edible oil in the world, and nearly 40% of India's domestic edible oil needs are met by imports of palm oil. Most companies are unsure what, in fact, will be an alternative plan in this scenario.
Companies in India are still recovering from the aftershocks of the announcement this Friday that Indonesia is stopping all exports of palm oil. Indonesia is the largest palm oil producer in the world, accounting for more than half of the world trade in the commodity. With the war in Ukraine stopping the flow of sunflower oil produced in Central Asia to the world market, demand for palm oil has shot up, pushing up its prices and making it unaffordable in the local Indonesian markets. Authorities there responded by cutting off exports to ensure local supplies. In 2020-21, palm oil made up to 56% of India's edible oil imports. 40% of India's oil consumption is palm oil. More than 8 million tons was imported last year. Analysts expect an unprecedented price shock, the likes of which has not been recently witnessed across the globe. Palm oil is used not only in food, but several daily use commodities. Cakes, chocolates, biscuits, noodles, butter, cooking oils all use palm oil and its derivatives. Even cosmetics, soaps, shampoos and cleaning products use the imported oil. In fact, India's dependence on the oil is so complete that Baba Ramdev had this to say.
250-300 रुपए तक एमआरपी पहुंच गया सनफ्लावर का जी घी के बराबर पहुंचने वाला बिल्कुल और बात खाली सनफ्लावर की नहीं है पाम ऑयल इंडोनेशिया मलेशिया से आता है तो बीच बीच में भारत के खिलाफ बकवास करते रहते हैं कोई भी देश आत्मनिर्भरता के बिना आगे नहीं बढ़ सकता
तो तेल में हम आत्मनिर्भर क्यों नहीं है
तो इसमें किसी ने कोई बड़ी पहल की नहीं पहली बार मोदी जी ने अभी 1200 करोड़ रुपए का ऑयल पाम मिशन लॉन्च किया है और खाद्य तेलों में आत्मनिर्भरता के लिए पूरा एक स्पेशल एक टास्क फोर्स बनाई है और इसमें बड़ी भूमिका पतंजलि रुचि सोया निभाएगा तो ये एक बहुत बड़ा कदम होगा करीब 1.5 लाख करोड़ रुपए इस साल गया है 1.5 लाख करोड़ रुपए फॉरेन करेंसी का नुकसान हुआ हमारा
Meanwhile, India and the industry have no option but to shell out more. Prices are up nearly 75% on year And all other imported cooking oils like sunflower oil and soya bean oil are costlier as well. Buyers are already flocking to Malaysia, the second biggest palm oil exporter, but analysts are clear that nobody can compensate for the loss of Indonesian palm oil and every consumer is going to suffer. Bureau Report, Business Today TV.
Government has filed a revised DRHP for the LIC IPO. According to sources, capital markets regulator SEBI is likely to approve the updated DRHP today, and the government is aiming to file final prospectus for the LIC IPO by the end of the week. Let's head across to Karishma Sudani for more on this. Karishma, what's the revised valuation the government's looking at, and how much stake are they looking to dilute?
Well, Abha, what we have to first consider is the fact that despite headwinds on inflation, the Ukraine crisis and COVID pandemic, government has finally taken this call to launch LIC IPO in first week of May, and sources are telling us that the final plan has been set in place. In fact, by the coming Wednesday morning, government will be able to finalize the RHP, which will have key details on the issue price, issue date, discounts and reservations. An updated DRHP has already been filed with the SEBI. The government is looking to launch LIC IPO in first week of May. It's been much awaited news, one of the biggest IPOs that the market, Indian market is waiting for. And what's interesting is that analysts are guessing that the price could be somewhere around between rupees 900 to rupees 1100 per share. Government has set a valuation of rupees 6 trillion and is looking to raise 21,000 crore with a 3.5% stake. That's a reduced stake amount percentage from 5%, for which government will also have to seek SEBI exemption, which is also, as per sources, affirmative and likely to come in any time this week.
Thanks, Karishma, for taking us through that. We'll keep a keen eye on the upcoming plans there. Now, as incidents of electric two-wheelers catching fire in various parts of the country have triggered concern, electric vehicle manufacturers are meeting senior government officials. Ather Energy CEO Tarun Mehta trooped in today to meet top officials of the Road Transport Ministry, headed by Nitin Gadkari. These meetings come after Road Transport and Highways Minister had warned EV makers after a spate of deadly electric two-wheeler fires. With employees heading back to offices now, how will the future of work shape up? Is the hybrid model a preferred way with the COVID threat still persisting? V.V. Apparao, Chief HRO, HCL Tech, in an exclusive conversation with Managing Editor BTTV, Siddharth Zarabi, says that the shift to working from the office depends on a number of factors, including government policies.
How is the work from office, work from home, hybrid work environment shaping up for such a large employer as yours?
Yeah. So, throughout the last 2 years, the people who were coming to our offices was around 5%, 4%, 5% kind of, right? In some cases, the customers were not interested. In some cases, employees they have relocated to their places. But as we speak, in the last 1 month, we are seeing increasing numbers. Today, we are hovering around 12 to 15%. Right, it will take a few quarters for people to come back to the base location, start coming to office. But the good thing is, though, on any given day, our attendance is 12 to 15% in office. We are seeing unique employees coming to offices has increased to almost 50%. Right, so I may be attending only 1 day in a week, but if number of unique employees, if I'm looking at, we have 160 and 170,000 people in India, which means 85,000 of them at some point or other in the last 1 month have attended office. So we do expect it will be a hybrid environment, unless otherwise there are situations like customers demanding that they will be in office, or there is some data security issue that has cropped up. So these are some of the unknowns that we have. But otherwise, we do believe that it is likely to be a hybrid environment of probably scaling up to 40 to 50% at max.
So effectively, are you saying that 100% work from office environment is now a thing of the past?
We don't know, Siddharth. Like I said, we need government's approval also for that, because we work in SCG premises, right? These SCG premises, government is giving permissions from time to time. If government doesn't give extend that approval, then all the people working in SCGs have to come back to office, right? Otherwise, the taxation benefits that are there, they will not be applicable, right? So it depends on the policies of the government. It depends on the behavior of the customer, and the unknown part is the cybersecurity incidents or data privacy issues that can crop up. Touch wood, so far nobody has reported any major incident.
And that's where we leave it on the show today. Thanks so much for watching.